Welcome to Long Story Short, a podcast where two financial advisors, one rooted in financial planning, the other in investment strategy, break down the questions we're actually hearing from our clients. Each episode, we tackle one or two real-world issues that matter to high net worth individuals, from market-moving news to personal finance decisions with lasting impact. No jargon, no fluff, just clear, thoughtful insights from the front lines of wealth management. We keep it short, but we don't cut corners. This is Long Story Short.
Welcome to Long Story Short. My name is Andy Pratt, and I'm joined by Adam Newman. A couple things here. One, we both have names that start with A and are 4 letters long. And so everyone always seems to get our names mixed up. But Adam, you also have the unfortunate case where your name is the same as the Adam Newman from WeWork infamy. Are you and that Adam Newman the same person?
No, that Adam Newman has much better hair than I do. If you've seen pictures of him strolling through the streets of Milan or New York City, you'll notice his long, wavy locks, and it's often walking around barefoot. So I'm not a long-haired man that walks barefoot, but he's got great hair. This morning, we got timely to our conversation last week about alternative investments and their attractiveness and their increasing popularity, but also the fact that it's a little bit like the Wild Wild West. I saw an article this morning that I pushed over to you that was about YieldStreet, formed in 2015. It was one of these online investment platforms that touted the democratization of alternative investments. And it's really, just to sum it up, it talked about how even relatively sophisticated financial minds were now claiming they lost to the tune of hundreds of thousands of dollars in these Yield Street investments. Are you surprised, not surprised, or somewhere in between?
Well, the marketing tagline is just genius. Invest like the 1%, right? Like, who
Yeah,
doesn't
exclusivity.
want to invest like the 1%, right? But am I surprised? Can't say I'm surprised by this, unfortunately. I don't know about Yield Street's, what their motives are, right? I'm sure they're trying to do the right thing in terms of investing their clients' money. I don't think it's some sort of a scam or a Ponzi scheme or anything like that, but it just goes to show how so-called sophisticated investment management and the democratization of those types of strategies are usually easier said than done. I know, we've, as a long-standing registered investment advisory firm, manage billions of dollars of money on behalf of our clients. One thing we've learned in our search to get access to, more alternatives for our clients is that oftentimes it can be really difficult to access the best types of alternative investments that are out there. Even we, with our track record and scale, find it hard to get access to the best types of deals that exist. And so, am I surprised that sort of an opaque alternative investment, bring that to the masses sort of thing didn't work? Unfortunately, I'm not surprised at all.
Yeah, I think they had a killer marketing strategy. They had a big marketing budget too, because it's not often that I have clients, knocking on the door and saying, "Hey, listen, have you heard about this alternatives platform?" And normally it's a stock or some other investment theme. It's not usually an online alternative real estate investment platform. But I had several clients bring this to my attention over the past few years, and the idea that you can take a minimum investment of a couple $1,000s and throw it into a new luxury apartment building in Nashville or an office building in the Chelsea neighborhood in New York. It just like felt all wrapped in like a 20% target rate of return. Seemed really attractive,
Yeah.
and
Those
and
swanky
I guess made
areas, right?
sense.
Like
Yeah,
Nashville is growing like crazy. The Chelsea area of New York, right? Like,
right. It all made
there's
sense.
right.
But easier said than done. It's like the old adage, if it sounds good to be true, it probably is. And Like you said, I don't think it's it's not to say that this is some sort of a Ponzi scheme, but there's a lot of money out there chasing big money, chasing real estate deals, chasing private equity deals, a lot of sophisticated, highly networked money, chasing after the best and the brightest. And to say that you can just auto deposit a few $100s into these same opportunities is wishful thinking. And
Yeah.
is it fair, Andy? Like, is it fair just to, kind of go down this alternative investment rabbit hole one more time? Do you look at it differently if it's an alternative investment that positions itself from a return standpoint? For example, hey, we're going to get 15, 20 plus percent return versus, hey, we're an alternative investment or an asset class that's really meant to diversify against the other things in your portfolio. So return might be one piece of it. It's not to say that it's, trying to shoot the lights out in terms of gains, but the positioning is more from the standpoint of I'm a diversifier. Do you look at both of those opportunities differently?
Yeah, certainly. I think we can talk a little bit about like red flags in this article as well. Um, but certainly one of the red flags that I see oftentimes is when an investment comes across my desk, and trust me, I get pitched all the time in my day job on, various alternative investments with, these crazy cap rates, these, targeted returns, things like that. And when that number is pretty high, it's typically a warning sign. Like some sort of warning siren is going off in the back of my head. Like, okay, this is probably a little bit too good to be true. Not to say that yields and returns and things like that aren't important. They certainly are. But whenever I'm evaluating an alternative investment in a portfolio, I really view it as through the lens of both risk and return, right? You have to view it through both lenses. So obviously, if you're investing in something that's not going to return anything for you, no matter how diversifying it is, like it probably doesn't seem like a very good investment in a portfolio. That was, for the record, that was bonds for much of the last decade, or at least
Right.
the ZIRP period, right? Zero interest rate
Mm-hmm.
period. So I'm not saying returns aren't important at all, but when you're looking to add an alternative to a portfolio, keep in mind like you already have your equity allocation. That's the growth engine. And you're looking for other things to smooth out obviously with stocks, they go up and down like crazy, right? You want to smooth out that return stream. That's why you have diversifiers in the portfolio. And to me, that is where alternatives really should warrant their inclusion in a portfolio. So if you can find something that has a differentiated return stream that isn't correlated with the types of business cycles or economic booms and busts that drive stock returns, that can really increase your risk adjusted returns at the end of the day. So these types of investments like this, where they really only ever talk about the return, the return, the return, got to ask yourself, is this actually going to help diversify and make my portfolio less risky, or at least help lower the amount of risk that I'm taking from stocks? Or am I just adding risk on top of the cake?
Yeah, great point. And last week we talked about investing in a theme and the pitfalls of investing in a hot theme of the day. We talked about 3D printing, nanotechnology, cryptocurrency. For me, this falls under the category of, in terms of investment lessons, investing in an asset class, not a single manager
Right.
or idea. Like YieldStreet, for example, they were touting the benefits of real estate, but really through their manager lens. Uh, and as an investment advisor, we're looking at an asset class, meaning it doesn't need to be one single manager doing this. There might be multiple managers to choose from, but when we're deciding whether or not to put something in the portfolio, it's based on the characteristics and long-term history of this asset class and how it interplays with the other pieces of the portfolio. It's not, oh, hey, we found this manager
Mm-hmm.
in this part of the world that does this really esoteric thing, but they've got a great track record and we can access them. Let's do it. It's asset class first and then manager second.
Yeah, that's right. Absolutely. Like there's all sorts of asset classes that have an established track record, and that's really what you want to get exposure to. So I want to get exposure to private equity, the asset class, first and foremost. That's what you need to decide. Do you want that? And then step two is find the right manager, right? It's the same thing with equities or bonds or, any other type of mainstream asset class too, right? You have to first say, hey, how much of my allocation do I want in US stocks? 50%, 70%, 100%, whatever it is, and then you go find who's going to actually give you that allocation. It could be an active manager, it could be something that's passive. It's really personal preference as far as what you go there, but you're going to have a separate due diligence process for that. The thing that really, when I look at this, this YieldStreet CNBC article that you sent me, one of the things as another like red flag that goes up is they talk about this one person who put in $400,000 into just two real estate projects, right? And unfortunately, you got to feel for the guy, right? He ended up basically losing all of that money. But that's essentially like putting $400,000 in just two stocks, right? If you do that, even if they're high quality stocks, you're going to take on quite a bit of risk, and you do in that case have like a max loss, total loss type of that's on like the list of possibilities, right? You could lose everything if you invest in just one or two companies. That's what people are doing here, and I guess they probably feel like, oh well, this is private, this is alternatives, everyone makes money
it's
here,
real
right?
estate.
It's
real estate doesn't go to zero.
It doesn't go to zero, right? But the same rules apply. The same sort of risk mitigation rules apply to the rest of your portfolio. It applies here to private equity as well. And so like putting that type of money in just two investments, I mean, unfortunately, this is the type of thing that can happen.
Yeah, and note of caution, I guess, to wrap up this particular lesson, this is only the beginning. These types of alternative investment platforms are going to, especially with advancements in AI and technology, they're going to become more prevalent. You're going to get more Facebook ads of, these sexy alternative platforms with 20% returns. And always call timeout and ask the question, does this asset class, does this category belong in my portfolio? If so, how much? Then you go along the due diligence phase, hopefully alongside a trusted advisor, because these things are, it's the Wild West. I don't know how else to
It's the
describe
Wild
it, but
West.
interesting
Yeah.
article, and we'll see more of it.
Yeah, for sure. Hopefully, we see less anecdotes about people losing $400,000, and hopefully, people who listen to this podcast can avoid that fate. But yeah, I'm sure, unfortunately, we'll see more. So Adam, in recent episodes, we've been asking people to solicit. We've been soliciting questions directly. Our email address is longstoryshort@bernie.com. If you do have questions, you can send them to us directly. We launched this podcast because we're both financial advisors who get very similar questions from clients all the time, and we just wanted to start that conversation a little bit more broadly. And in that spirit, we did get a question. So I'm going to read the question real quick that we got from one of our current clients on I think it was our YouTube comment where this question came in. Then I'll give you a chance to answer it, Adam. Sound good?
Okay. Yep.
All right. First, your podcasts are really good. Thank you. He says he enjoys the casual conversation and delivery. That's really what we're going for, to try to make these topics, try to get them a little bit more casual, a little bit less stress around them. But the real question here comes to when we discuss staying invested. And we're talking about this is probably a situation that's applicable to people in retirement, but some clients need to withdraw funds even during down markets, right? And so the question here is to talk about withdrawal strategies that can help insulate investors from the dilemma of selling assets from their portfolio in a down market to provide the income that they need. So to formulate that into a more specific question, when we work with people who have just a recurring, steady need to draw from the portfolio, they need to draw from the portfolio during all times, both good and bad.
Right.
How do you help set them up?
Well, I think that it's a good question. I think this question covers on a number of different topics that we've discussed in previous episodes, and we'll kind of wrap it all together into one framework. And I think the first thing you want to be mindful of is and I think retirement is the use case here for this. Certainly, people need to draw on their portfolio through different phases of life, but most frequently it's during retirement. And we've talked a few times about asset allocation in retirement. How much risk should you take when you're going to start living off your portfolio? And that question gets married directly with this client's question about, well, what if I take a certain amount of risk and then the market tanks? Like, how does this all tie together? How do I mitigate that? And, we talked about the idea of determining what percentage of your portfolio needs to be withdrawn every year to fund your lifestyle. And that is a number very unique to you personally. And it's a big driver of the amount of risk you can take. For example, someone with $1 million portfolio only needing $10,000 a year that's a 1% withdrawal rate, very low by any standard you want to measure. Versus someone with $1 million portfolio and a 6% withdrawal rate needing 60,000 a year. That's what we would consider a heavier distribution rate from the portfolio. So we've got clients in all different, right? That's a spectrum. We've got clients that fit, within that, and even some higher and some lower. So the problem you run into when you're taking these portfolio withdrawals and you're too aggressive or you're even all in equities and you hit a really bad flat or negative market environment to where the portfolio is not growing in order to keep you ahead of those withdrawals and keep you ahead of inflation. So the doomsday scenario for someone retiring is they're way aggressive in their investment allocation. Let's just use all stocks as an example. The market goes down by 50%, so their portfolio that was once $1 million is now $500,000 in value, and they're still taking that same 60,000 a year. You've gone from a single digit to a double digit withdrawal rate, and those dollars that you're now spending from the portfolio at that much lower value, they never have a chance to recover when the market recovers. And so that's where we talked about sequence of return risk, and that's a fancy way of saying protect yourself or be really mindful of risk early in retirement or during periods of retirement where you need to spend a lot more out of your portfolio. So luckily you can plan for that. Luckily that doesn't need to be a disaster. Um, and let's go into some steps of how to address that specifically as you're thinking about portfolio construction. Uh, the first thing I'll say is that when you have a really, really bad market sell-off, the average time to recovery is somewhere between 4 and 5 years. That's for like a market crash. Typically, when the market falls 30+%, it takes a few years to get back to where it was before. So we're going to have the little 10, 15% corrections on average every year. The bigger sell-offs is really what we're planning for. And the easiest and simplest way to hedge against that, taking distributions from a really depressed portfolio value, is to have in your asset allocation some exposure to really less volatile and more stable investments like short-term treasury bonds and even short-term corporate bonds in some instances, or even a little bit of cash. And what that does is it gives you a bucket to pull from in the event the stock market takes a dive and you don't want to sell stocks at depressed values to fund your retirement paycheck. So, for example, someone with a $1 million portfolio, 100% in stocks, the entire portfolio value falls 50% in a 2008 like market environment. They've got nowhere to hide. They still need to take distributions unless they want to really cut their spending. They need to sell stocks that are at a discount. They want to be buying at a discount, not selling, but they're
Right.
selling things at a discount on the market to fund their paycheck. If that same retiree had 10 or 15 or 20% of their portfolio in short-term treasury bonds or safer, more stable investments, they don't need to sell those stocks. They can wait the 3, 4, 5 years for those stocks to recover and live off of the more stable portion of the portfolio while the market recovers. And that's essentially, you hear thrown out there, the bucket strategy. Um, and we don't, there are several ways to apply that. And some people say, hey, I'm going to take 5 years of my retirement living expenses. I'm going to put in something really safe. The rest of it, I'll invest aggressively for the long term. I mean, that's totally fine. Uh, the other way to approach it is just to say, what asset allocation am I overall most comfortable with given this new stage of life? And normally, when you do that, the allocation you pick, normally, because it's going to be based on the withdrawals you need to take from the portfolio, that will be one of the inputs of your risk level. Normally, when you do that, you have something that looks very similar to just that, hey, I'm going to park some living expenses in something safe. Those two approaches almost yield the same results, if that makes sense.
Yeah. Yeah, it's a tough problem to try to solve for, right? Because like on one hand, you don't want to be drawing from that depressed portfolio, but on the other hand, we know that holding too much in something like cash, like too much of your portfolio in cash just creates cash drag and ultimately can't keep up with inflation. So how do you think about finding what that right trade-off is?
Well, I think when we're talking about in the context of a portfolio that you're taking distributions from, even when you park, even when your investment allocation and your risk level still accounts for having several years of spending in things like cash and short-term treasury bonds, you still have a majority of your portfolio in equities and assets that are going to be growing and outpacing inflation over time. You just now have this bucket that's been earmarked as part of the investment mix that is your lever to pull in the event that things go off the rails in the stock market. So that is the other end of it. It's you don't want to say, well, I want 15 years of my spending in something really safe or 20 years. I've heard people say that. Well, why don't I just park my first 30 years of spending in bonds and cash? Well, now you're losing, but just in a different way. You're losing because inflation is eating away at your portfolio. So there's a lot of coaching that goes into that. It's, hey, we've got this moderately aggressive risk profile. You've got enough within that equity to bond to alternatives mix to weather through a really rough market environment, but you also have plenty to outpace of equities to outpace inflation over time. And I think that normally gives people peace of mind that um, if they retire and the market does really well, great, right? They're
Hmm.
participating, but they have earmarked in their mind what they can draw from in the interim. And that's why the asset allocation in retirement discussion is not a one side. That's why I hate hearing the rules of thumb and the direct advice that's, meant to be applied to everybody. It's we have clients that don't need to draw from their portfolio.
Hmm.
And those clients can be, if they're comfortable with it, 100% in equities in most cases. Um, and then we've got clients that are deferring Social Security. They are traveling a lot more early in retirement, so they're spending a lot relative to what they have. And those clients need something that looks and feels a lot different. They need more balance. They need that peace of mind knowing, hey, if we hit a really brutal bear market, I can continue on with life as planned. As long as you've got the right risk mix and you communicate with your advisor, you can weather through that because you don't need to sell equities at a fire sale. And that to us is like the art and the science of investment mix conversations. That's the fun part of what we do. But you'll see people all over the place, and risk can present itself in many avenues while you're thinking about that.
Yeah. Absolutely. And it's one of those things too. Like, so you're talking through people who have 100% risky asset allocation. They're all in stocks. I think most people are some mix, right? Like most people, especially in retirement, like and we'll make the case, and we have made the case that oftentimes people need to still be invested somewhat aggressively, because even in retirement, we're talking about a long time frame. But people you do typically have exposure to other asset classes that are less risky. So I think that's one of the other things you're talking about, where if the market does sell off, if your stocks are in that sustained drawdown, if you've got those other pieces of the portfolio, whether that's liquid alternatives, whether that's bonds, right, and they're holding up their end of the bargain, and they're staying up. And that's always an area too. Like, so you're talking about that short-term treasury allocation specifically. It's part of the overall asset allocation, but you've got that there to draw against should the market sell off. So in that case,
Right.
let's say you've got 60% of your money in stocks, 40% in bonds. You can take from the bond portion of that allocation when things get tough, and then rebalance again later. One
Yeah,
of
it's
the
flexibility and
right,
pulling the levers, right? Like
right,
think of it as flexibility. We keep coming back to that theme of flexibility, having the right levers to pull. And again, going back to this, like it doesn't mean you have to be all in bonds or too conservative. If you have a $2 million portfolio and you spend $100,000 a year from that portfolio, right? 100,000 out of a $2 million portfolio. If you have 20% of that portfolio in short-term treasuries or stable fixed income, right? You've got several years of spending in
yeah,
something safe, but then 80% of your portfolio is still in the market, is still invested for the
right,
long term. That's an oversimplification, but like it doesn't mean it doesn't mean that you need to, it's not like an all or none proposition. That doesn't mean that you need to have an overly conservative portfolio. You just need to have somewhere to draw from to take those distributions because the most detrimental thing for especially a new retiree, we talk about the retirement red zone, kind of like the couple years before retirement and then the first, several years in retirement. That's the most sensitive window for your portfolio for taking withdrawals. Uh, Definitely to get you through that. You can argue you can be more risky when you're in your 80s than you are in your 60s if you're
right,
retired, right?
right. Yeah, especially if your portfolio had a side. So I mean, I know we hate rules of thumbs here, but what your people are looking at 2 to 5 years in terms of living expenses and something short term safe, so that they can. The name of the game is waiting until the equities bounce back. Wait till the risk assets have a chance to bounce back. The whole game is avoiding having to pull from those assets when they're depressed.
Yeah, 3 to 5 years is normally where it lands. And again, we talked about in an earlier episode what goes into that decision around how much risk should I take. There's two inputs to that. What's my appetite for market swings? Can I stomach stock volatility? And if so, to what extent? And then the second is, the quantitative piece, my personal circumstances. How much do I need to draw from the portfolio every year? How flexible am I with my spending? What other income sources do I have? Those two marry together and help determine your overall investment mix and what's most appropriate. And I can say 9 out of 10 times we go through that exercise with a client or a prospective client, then that asset mix ends up landing into the framework we're describing. They'll have several years of spending in something more stable, less volatile, but still a healthy allocation to growth because I don't know if you've heard anything about inflation in the headlines recently. It seems like we've been talking about inflation every day for 3 years after not talking about it
Yeah, we
at
kind of
all
have,
for
haven't
many
we?
years. We've gone from like inflation is dead, it's never coming back, to even a worry about deflation and disinflation. And now it's like every week there's some new indicator coming out that makes us more worried about inflation. And that's a big piece of, when we're talking about risk, we just talked about risk in terms of risk that the stock market goes on sale and sells off, and we have a bear market, which happens on average every 5 years. Um, but the other risk, and we argue the bigger risk to a multi-decade retirement is inflation. So
Hmm.
I kind of covered one side of it. I covered the if the market hits the fan, what do we do side of it. But give me your like rundown on the other piece, which is the how does the inflation equation factor into these allocation
Yeah, I
decisions?
mean, inflation can be a silent killer, right? If you take your money and you just put it under your mattress, right? Even if it's a lot of money today, you might wake up 20 years from now and you'll know that those dollars don't go nearly as far as they once did. right? And so that's the other piece of this. So, we were talking through the lens of having something to buffer against the relatively short but dramatic downward swings in equity markets. But really, equity markets also help hedge against the steady, consistent killer that is inflation, right? Where your money is just losing a little bit of its purchase power every single year. And really, the only way to counteract that is to invest. So there's a couple things whenever we hear inflation, people talk about inflation hedges, right? And so people will say
Gold.
gold, right? Gold's an inflation hedge. Real estate is an inflation hedge, right? And I think that's a little bit, I don't know.
Iraqi dinar.
Exactly. But like what we know, like we just read that, we covered that article to start, right? Where real estate was being billed to these people as an inflation hedge, except that these really risky real estate deals they went into, went to zero, didn't make any money, right? So that's really just a huge risk. I would say that if you're really looking to mitigate inflation, you just need to factor that in to your overall asset allocation, right? That should be in your strategic asset allocation from the beginning. Because the fact of the matter is, it's boring, but stocks are a great long-term inflation hedge. I don't think you have to go really any further beyond stocks to get what you're looking for as far as an inflation hedge, right? You obviously have to figure out what's the right mix of assets, right? You still have to fit your overall risk profile. But if you can stomach the short-term risk that comes from investing in equities, if you look historically, they've been able to well outpace inflation. Even in these periods where inflation is high, you still see stocks outpacing inflation, right? So I really think that the answer is simple. You just have to make sure that you're avoiding too big of a cash position in your portfolio. And as long as you have that invested towards your targeted risk allocation, I mean, that's most of the battle right there. Would you agree with that?
Yeah, absolutely. And I think there's a misconception. Like I feel like, this happened in 2022. A lot of people have they draw this connection between inflation and a bad stock market. I don't know if it's just the fear in the headlines during inflationary periods, but there's this belief that if inflation is high, it means the stock market's going to tank.
Mm-hmm.
And I think, certainly there's scenarios where there's concerns about recession and, the economic outlook
How the
in any
Fed's
window
going to
of time.
react, right? Yeah.
Yeah, right. The Fed, what the Fed does, what the consumer does. But like we've gone back and you've looked at inflationary periods, and they tend to be when the dust settles, great windows of time for stock investors,
Right. Well,
right?
even look at
Yeah,
2022, right? 2022, it was like the everything bear market. Stocks were down, bonds were down, inflation was high, right? And it wasn't really inflation that was driving stocks to fall. It was the Fed's really aggressive path of rate hikes and uncertainty of what that would do to the economy.
right.
But if you held, so you might point to 2022 and say, hey, inflation was high, stocks were down, stocks didn't work as an inflation hedge. But then if you just fast forward the clock and go 23 and 24 and so far this year in 2025, and you held stocks from 2022 till today, you have trounced inflation over that entire time frame, right? And so that's really the thing. Like with inflation, you're not necessarily looking at it's not a 1 year risk. Inflation is a 20, 30-year risk, right? Because it has to compound, it has to get bad enough. And to me, that's where stocks really do their job as that inflation hedge. They hedge that inflation over that 20, 30-year window that otherwise would kill the purchasing power of your money.
Yeah, we've all seen the Big Mac charts, like, hey, here's what a Big Mac cost in, 1972 versus today. And you see it in what I love is I see this sometimes in real estate where people are like, "Oh, wow, look, they bought this property in
Oh, you see this all the time,
1968.
right? Yeah,
They bought it for 50,000 and now it's worth 1 million." But you're like, "Yeah, but if you invested that same 50 grand into the stock market, it'd be worth
right.
like 3 times as much as the house." So, and it's simple.
And would be a lot cheaper to hold over that time frame too. I don't know.
Yeah, cheaper to hold.
This
Yeah,
is something
definitely.
Ben Carlson always says um, over at what's that podcast they do? Animal Spirits, right? He always is
Yeah.
making the point that don't view your house as an investment. It's something you use. You live in it, right? Maybe it will appreciate in value. Maybe your parents' house went from $50,000 to $1 million in value, but you also have to factor in all the costs that come with that house, right? You've got property
Yeah.
taxes, insurance, things break, you have to fix them, right? All that stuff has to factor in. So, I love when people do that because I think it's that a house is tangible. You can see it, you can live in it, you can feel it, right? You can't do the same with your, stock market portfolio. But people do that type of thing all the time, where they talk
Right.
about how great of an investment it was and how expensive real estate is today, when they could be making the same points if they just invested in the stock market.
Yeah, no, absolutely. One of the fun anecdotes of, the Twitter world and the Facebook world, seeing those things pop up and making those comparisons. Well, and the reason for all of this is simple. Look at S&P 500 corporate profitability today, right? Profit margins are expanding. Companies are
Hmm.
becoming more profitable in an inflationary environment. Why? They can raise their prices. They can, right? As a consumer, there's difficulties in making consumption decisions, but as an investor, you look at inflation for most corporations, as long as wage inflation doesn't go spiral totally out of control, it's a good thing. They're ultimately at the end of the day going to charge more to get a profit. And that's
Right.
that's how businesses operate
Yeah. And
and
they can come
how
up with
they
an
should.
excuse to raise prices. They will. And for a lot
Right.
of things, people will continue buying.
Yeah. I mean, God, this has just been such a brutal window for the fear mongering investment commentary. We've gotten through. Go back, Brexit. Just since the great financial crisis, you had all the European debt concerns,
That's right.
Brexit, uh, COVID, 2018 trade war,
I'm still
2022.
waiting. I'm still waiting for that recession to come. By the way, from the Fed's rate hike uh, process in 2022, we're still waiting on that recession. 100% chance. It's right around the corner, right?
Well, we will have a recession at some point. It's a feature, not a bug. It's just a matter of when. But most of the time, when people try to guess, they are incorrect, and they still continue to be.
Yeah. The bottom line is, I mean, I think more recently, earlier this year, and still year to date, we've seen the rest of the world do really well. Their stock markets do really well, and people were pointing, well, look at Europe, look at Germany, look at France, look how well they're doing, while the U.S. is down in early April, and there was this like big pushback against American exceptionalism, so to speak. It was like this whole "sell America," online trend, and my point is, I'm not going to bet against the U.S. economy and the U.S. stock market until proven otherwise. It just,
No.
that's where the smart money has been for quite some time.
Yeah. And as a retiree or as someone making that transition to living off their portfolio, you can still have that long term positive, optimistic outlook in your as an overarching theme in your investment allocation. You're simply just going to hit a window early in your spending years where you need to hedge a little bit against that and make sure that if, that environment that we normally hit every handful of years where the market sells off, if that lines up with your exact retirement date, then you've got somewhere to draw from. And that's one of the more exciting things we get to coach people through. Um, and it's also really great when you have clients that don't need to live off their portfolio and you could tell them, hey, don't worry about a short-term correction or bear
Right.
market. It's insignificant. You're investing for not only your lifetime, but multiple generations in some cases. So all fun and exciting things. We got great question for this week. Please keep them coming. There's a lot of different ways to send them through. Long story short, at Burney.com is an email address,
Right.
but people are
And hey,
savvy. They're
and
doing this through YouTube.
yeah, and our YouTube commenter said that he's already recommending these podcasts to family and friends. Please, we do want to grow the audience, so follow his lead, recommend, forward, like, subscribe on all the podcast channels, and really, the more you recommend us to your friends and family, I think the more good that we can do, the more we can spread. I think like good sound advice when it comes to investing, and kind of, avoid the negative headlines, the TikTok influencers, and things like that, right? We want to be that rational voice of reason. That's the whole reason why we launched this podcast. So we appreciate everyone who does share this podcast, and it's the biggest compliment we can receive.
Until next week.
This podcast featured Adam Newman and Andy Pratt of Bernie Wealth Management, which is a division of the Bernie Company, an investment advisory firm. Adam is managing partner and is chartered financial analyst, certified financial planner, master of taxation, and retirement income certified professional. And Andy is senior partner and director of investment strategy and is a chartered financial analyst and chartered alternative investment analyst. Long story short involves general discussions of a broad range of current financial topics related to financial planning, taxes, investment, and retirement. This content is for informational educational purposes only and is not intended as personalized investment advice or recommendation. It does not take into account your financial situation. You'll need to consult with a qualified financial advisor or professional who is familiar with your specific circumstances. Investing involves risks, and past performance is not indicative of future results. The Bernie Company is an SEC registered investment advisor. Registration with the SEC or any state securities authority does not imply the Bernie Company or any of its principals or employees possesses a particular level of skill or training in the investment advisory business or any other business. Bernie Company does not provide legal, tax, or accounting advice, but offers it through third parties. Before making any financial decisions, clients should consult their legal and/or tax advisors.